And let's invite the first corporate on the show, and that is Mahindra Holidays. It's in focus in the back of a very good quarter. Remember, this was the first normal quarter since COVID. So at least we've not had a normal Q1 over the last 2 years. This has been one, which is why the numbers are looking good. There has been a revenue growth of 63%, operating margins expanding to 16.8%, and there is a profit this time of 30 crore versus a loss same time last year. Kavinder Singh, the Managing Director and Chief Executive Officer at Mahindra Holidays and Resorts India, is now with us. Morning, and thanks so much for joining in. Q1 occupancy was about 89%. What has been the number in the month of July and your expectation for occupancies going ahead?
So the most interesting aspect is, as you rightly said, the Q1 occupancy was 89%. And mind you, pre-COVID, we used to have 3,600 rooms and we now have 4,600 rooms. So despite adding 1,000 rooms, during the pandemic, our occupancy has remained at 89-90%. These are industry-leading occupancies. Just to talk about July occupancies, July occupancy closed at about 82%. If I were to look at the quarter two, our occupancies are likely to remain above 82-83% as far as the quarter two is concerned. And the most important part is that we achieved the highest ever revenues in our quarter as well as at the resort level.
All right. Good morning, Mr. Singh. Thanks a lot for joining us. This is Pavitra. So your revenue run rate has been quite solid this time. It's over 60%. Can you tell us what is the sustainable run rate going forward on the revenue, and what is your current unearned revenue as well?
So as far as the revenue is concerned, it has been bolstered by two things. Number one, our resort revenues, which really moved up on the back of very high occupancies, as well as the fact that we have extra 1,000 rooms from the pre-pandemic level. Also, our holiday club resorts revenues were up by 60%. So that is where you see at the consolidated level, the revenue moved up by about 63%. As far as the margins are concerned, and which is equally important, that when you move up the revenues, the margins must also go along with that. We saw a bolstering of margins at the consolidated level from 18 to 20.7%. And also at the balance sheet level, our cash remained robust at about 1,172 crores.
Okay, hi, Mr. Singh. So these margins, when do you hope that they might get back to the pre-COVID highs? And also in terms of, now that things have opened up, do you expect that your sales and marketing expenses might go higher?
The good news for us is that we actually had about 10.7% as the pre-COVID margins, and we closed the profit before tax margins at about 15%. So we are actually higher than the pre-COVID margins now. A lot of actions have been taken to ensure that the margins remain high, whether it is in terms of the solar facilities, the panels that we have installed in 16 of our resorts during the pandemic. And despite adding a number of resorts, including adding 1,000 rooms, we have been able to manage the cost extremely well. We have variabilized our costs. Most of the fixed costs have been variabilized, and that is why there is a big jump in the margins from pre-COVID to post-COVID levels.
So, Mr. Singh, can margins sustain above 15%?
So at this moment of time, we are this is the best-in-class margins in our business, 15% at PBT level and about 11%, 11.5% at the PAT level. Margins would definitely be sustained. In fact, our aim would be to grow the margins. But let me hasten to add, as was alluded earlier, that the sales and marketing expenses, as we go and press the throttle on the member acquisitions, could go a little bit high, but there are other levers that we can press to ensure that we are able to sustain margins going ahead.
Okay, you will try to sustain margins going ahead. Mr. Singh, if I can also ask you, what is the kind of member addition that you're looking at so far for FY21, FY22? We saw around 12,000 to 13,000. What can we expect for this year, for FY23?
So you would know that in quarter one, we added about 3,807 members. And as you can see from the run rate, we are already running ahead of the last year. Obviously, last year we had Delta and Omicron. But what gives me most happiness is that we have added these members with very high down payments, which has bolstered our cash position, number one. Number two, we are also seeing momentum in the member additions looking ahead. Our quarter four is typically a very heavy quarter in terms of member additions. So already in terms of run rate, we are doing much better than last year. And also the fact that we have products which suit all the life stages of our customers will definitely help us to grow our member acquisition at a faster pace. And remember, the digital route is becoming very, very important route for member acquisitions as well as the referral route. And I often say that our digital penetration, when I look at the payments, when I look at the behavior of the customers, actually, if I look at pre-COVID to post-COVID, we are 100% up on the digital side of things, whether it is payments, whether it is acquisitions of members. So digital is playing a very, very big role in our strategy to grow the business.
Mr. Singh, qualitatively, can you give us some more color on these member additions? You have different classes of members, right? So where is it that you're seeing more traction? Do you also differentiate between the tenures that they are paying for? And my second question is on your overseas operations. I think the outfit in Finland was seeing some trouble. So if you can give us a sense of how things stand.
Sure. As far as member additions go, the member additions today comprise of three types of products. We have a 25-year evergreen product. We have a 10-year product, which is a points-based product, which is targeted at people above 50, 55. And then we have a 3-year. We are seeing momentum in all the three. In fact, just to let you know, our product mix improved significantly. Our average unit realization, which was 1.9 lakhs in the last year, same quarter, is now up to 3.8 lakhs, almost hitting the pre-pandemic levels. In fact, we are likely to see even traction up there. So in terms of the product mix, it's an improving product mix. Number one. Number two, in terms of the fact that members, when they come in, they have an option to take the any of the tenures, of course, depending on their life stage, but they also have an option to pay a very low down payment and become our members. So we have been encouraging members to do higher down payment, and that is something that is tracking very well in our internal metrics, which means the quality of member additions is also going up. And by the way, it is a strategy that is something that we have been following for a very, very long time, now 3 to 4 years. And you look at our member spend, if you see our resort income, which became 84 crores, which was the highest ever, it's not just the occupancies which got us that resort income, but also the fact that members are spending, the per capita spend of the members at the resorts is on a 18% high compared to the pre-pandemic level. So there is a momentum that we are seeing of right quality of member additions. There is a momentum in the fact that we added 800 to 1,000 rooms from pre-pandemic to post-pandemic. Not only that, we are seeing high occupancies, we are seeing higher margins, we are seeing a better cash position. So I think the time for the leisure-focused businesses like ours is now. We are in an extremely sweet spot as I think about it. Even despite the high inflation, our proposition remains extremely relevant because when people sign up for our membership, they do not have to pay for the rooms over the next 25 years. So in some manner, you are protected from the growing inflation.
Mr. Singh, it's a pleasure having you with us on Trading Hour. Thank you very much for joining in, but we need to get into a very short break. On the other side,